All right. So I'm excited. It's like game day all over again. I played a bunch of soccer at Carleton, and putting my slides together and stuff. It's like the anxiety builds up, the stress. But I started this. We did a presentation in October of last year, and I started my presentation with a book recommendation. The last time it was How We Sleep by Matthew Walker. This time, Dave Ramsey. A lot of you probably know who that is, but if you don't, he's like famous for this Baby Steps Millionaire, and it does a really good service of giving you a basis for investing. It's a short read, it's like 120 pages, and gives you some good saving tips. And then the last 120 pages is actually a statistical analysis. They did a study on 10,000 millionaires in the United States, took down their habits, took down their saving habits, everything that they do. And I did a minor in stats, so I was super interested in that part of the book as well. If you don't like reading, or if you can't read, that's okay. You can listen to the podcast. He's done a lot of them. But I like the one he did with Theo Vaughn. Theo asks a lot of really basic questions, and that's nothing against that. It's just he does a good job of getting a lot of information out of Dave. And if you don't like the long form stuff, I recommend just looking up this 8-minute video. Just look up Baby Steps, 7 Baby Steps Millionaire Explained. Again, important information in there. So again, I had this in my slides in October, and I just added the 2024 into it, but this is my 10,000 hours to studying finance. It's super rough, but I started back in like 2015, grade 10, grade 11. I took my accounting classes and whatever, intro to business. And then I started university 2017. I took commerce at Carleton Finance. I was doing a little bit more work in it. And then I actually started working in 2021. And that's when I started building up the hours. So up to 2024, I'm almost on that 10,000 hours of expertise where you could become an expert according to Malcolm Gladwell. So by early next year, I think I'll reach that point, but you learn something new every day still. So a little bit more about me. My name is Scott. I went to Carleton. I grew up in Ottawa. I played soccer at Carleton, 6 years. I played varsity. A couple of my teammates are here today. Super, super fun, and taught me a lot of things about discipline and time management. And then I finished that up in 2021, like I said, and I started working. I now work at Innovative Financial Group. It's my family's office. I work alongside my brother and my other brother, Justin, who's not here today, but he's an accountant to the right of me in that picture. And our dad started our business 45 years ago. And so we're pretty well established within the city right now. It's a small city. And I've stopped playing soccer because I tore my ACL, got surgery last year. So I'm still going through that. But a big habit of mine is golf right now. So if anyone wants to play me, I play for cash. I'm about a 9 handicap. I take Emmett's money all the time. So I'm going to start with a lesson for you. And this is something that I think that they should teach in all high schools, but they never get to it. It should be financial literacy. And this is going to be your lesson on tax. Okay? I know it's a huge bit of numbers, but we're going to focus on here and then this column right there. So a lot of people have misconceptions about how much tax you're paying, but once you actually start working in Canada, you pay tax even if you get a return at the end of the year. A lot of people say, oh, I got $500 back when I filed my taxes. No, you still pay tax. You actually just paid too much. So how do taxes actually work? January 1st, you start the year, you've made $0. Your first $15,705 that you make, you pay 0% on. Your next roughly $5,000, $6,000, you're paying 15%, and so on and so forth, right? Your next 20-something thousand dollars, you're paying at 20%, right? So another misconception that people have is, let's just say they make, I don't know, $52,000, and then they get a raise, now they're making $60,000, right? So they jump from tax bracket 24.15% to 29%. In the back of their head, they're thinking, oh, I got a raise, but I'm actually making less money. Also not true. You're actually just paying between $60,000 and $52,000, so that raise, you're paying a little bit in this bracket, and then everything between $55,000 up to $60,000 is paid at 29%. and then your tax rate averages out to whatever you paid in here. So a couple of misconceptions about tax, but if you work in Canada, you can be assured that you are paying tax. So we structured the presentation in a way in which I think the home buying process will happen for you. First things first, before you can even think about buying a house, you need to accumulate some money. And you're going to do that by investing, saving, setting a budget, maybe working with a financial advisor, doing some of it on your own. Once you've accumulated enough money to think about buying a house, you go and speak to a mortgage agent. That's Michael in the back. He'll be speaking after me. He'll run you through a mortgage application, get you approved based on your credit score, a bunch of stuff like that. Once you have an application that says, yes, this person is qualified to go and look for a home, you start the house hunt, and that's when Anthony, real estate agent, comes in. You'll be working with a real estate agent, looking at houses, working with a lawyer, working with house inspection. We left those people out because they're boring, and you don't really need to know what they do. I don't even know what they do, to be honest. But once you've done that, you've finished your house hunt, you found a house that you actually want to put a down payment on. Anthony's going to help you through that process. It's a hectic process for about 2 months. You're putting offers in, they're getting rejected. You finally get an offer on a house, and probably 2 or 3 months after that, there's going to be a closing date. And on that closing date, that's when you're handed the keys and you hand over the money, and boom, you have a house. And we've added a fourth step into this, and it's going to be post-purchase. And I think I've been to another couple of these events, and they leave out this post-purchase stage. And this is the part where you're going to protect your assets. So you've acquired assets, and now you want to keep them. And in case something happens to you, you want to make sure that it's covered. And you do that through insurance. And that's going to be Miles, who's going to be speaking at the end. So before we can even start, I just want to give like a very base level of what investing actually is. You can invest in many different things. You can invest in yourself, go to the gym membership. You can invest in your business. If you have a small business, let's just say you run a construction business, hiring employees, buying the equipment, buying the materials, that's going to be an investment. The one that I specifically do is through the stock market. How do you do that? You invest through investment products, right? You can buy many different products, stocks, bonds, GICs, mutual funds. The ones that we specifically focus on are mutual funds and alternate products. However, I'm licensed to buy any of them. And how do you purchase these investment products? You do so through investment accounts. You have two options. The first option is tax efficient accounts. Second option is non-tax efficient accounts, right? So that's why I gave that lesson at the start about tax, because investing is not only about earning return, it's actually about maneuvering through tax at the same time. The good thing about these accounts, you've probably heard about them, TFSA, RSP, FHSA, is that they have tax benefits to them. The bad thing is that they have limits. They have contribution limits. So let's say you've maxed out all of your accounts that you can possibly max out, and you still want to invest. That's when you'd go to something like a non-tax efficient or a non-registered account. The only difference, you're buying the same product, it's called a mutual fund, in your TFSA or your non-registered. However, the product in your non-registered account is going to be subject to tax. So why do we invest? I can think of hundreds of reasons, but I'll leave you with 3 that I think are pretty pertinent here today. Obviously, you want to make money when you're investing. Put money into something, you're trying to earn a return. Another really good reason is for planning. Came across this article. Canadians say they need 1.7 million to retire. I think that's a crazy high number, but it's achievable. They go through it in the article. But I think it's false in saying that there's a number on your retirement that you're going to be comfortable with. Your financial circumstance changes all the time, and your retirement isn't going to look like anyone else's retirement. The last reason, as I kind of alluded to, you're going to save on tax through these accounts. And I'm going to speak about the FHSA specifically today, and I'll give an example of how you actually save on tax. So again, I put this on here just to give you a bit of an indication of how different asset classes have performed over the last 100 years. So again, what can you invest in? You can invest in stocks. So that's, again, what I do. Or you can invest in bonds. That's the same thing. You can hold a bond in your TFSA or anything like that. But I'll highlight the 2 stocks and real estate, right? These are both accumulating over decades at double-digit numbers. There's some oopsie years in there. 2000s was pretty tough. They had the 2002 dot-com bubble. That's when all the tech companies were start coming out. The internet just got created. It was created earlier than that, but that's when the companies started forming. And every single company with a dot-com at the end of it was projected to do amazing. It eventually blew up and a bunch of people lost money. And then there was the 2008 housing crisis, right? Real estate is your other huge play in what you're investing in. Again, they're accumulating at very positive returns over those time periods. In the 2020s, they were double digit as well. And why? Well, it took a worldwide pandemic, and I think everyone in here knows what happened in the housing market during that time. What are your decisions in terms of investing? And it really comes down to two options. You can work with an advisor, or you can do self-directed. And how do you choose between the two? Well, self-directed is, you're going with one of those apps out there, or you go to a bank and use the app and you purchase your own products. Or you can work with an advisor. And typically most advisors are going to charge 1% annually on the amount of money invested. So the difference between the two is 1% for all of the advice, all of the accounts, the trades, the recommendations, etc., reviews, or you can save the 1% and do it yourself, but you're responsible for all of your decisions. So again, 1% annually on the amount of money to save you all of the time. My dad uses this reference all the time. If you want me to build you a fence, I am not the guy for that. If you want investment advice or tax advice, probably come to me first, right? So again, when you're working with an advisor, you have a couple choices. You can go to a bank, or you can work with a private advisor. And when you're working with a private advisor, you get a couple key benefits. The first one is you're going to get personalized solutions for your objectives. Everyone has a different circumstance, and like I said, your circumstance changes all the time. Someone has kids, someone doesn't have kids, someone has rental properties, someone's looking to retire, someone's looking to get in, right? There's a bunch of different options out there. So working with an advisor that understands your circumstance specifically is going to be able to give you some pretty good advice. Another big one, and this is specific to our office, you can have all your assets under one roof. We do investments, we do insurance, and my oldest brother is an accountant. So if your investment guy knows what your insurance guy is doing and your accountant knows what those two are doing, you're going to get the best bang for your buck in terms of service. And here we go right here. Next big thing, I think it's counterintuitive nowadays, but service is a huge deal. You try to call a bank, you probably look like that guy. I've called so many banks and geez, so many wasted hours. I'm pressing 2, 7, 4, like it's just ridiculous. So, another huge benefit to working with an advisor is you have a quick question on a weekend, call them up, text them, whatever, and you're probably going to get an answer pretty quickly. And the last thing, again, it's specific to working with a private advisor. As opposed to working with a bank, you're going to get unbiased recommendations. You go work with an advisor at TD, they're going to offer you only TD products because that's what they can do. Privately, it doesn't matter to me. I get paid the exact same if I sell you a mutual fund or a stock or whatever. It doesn't change at all. And there's, tens of thousands of products out there, and we've narrowed it down to ones that we think are really good for our clients. And so a huge benefit is we're doing all the research on all of the investment products out there and recommending the best for our clients. So I don't know if anyone's seen these commercials. They're out there. This one specifically, I mean, if you watch any type of the Stanley Cup, they played this 270,000 times. But it's the one where they're talking about mutual fund fees. And I want to touch on that just to get this off my chest. This commercial does a really bad representation of how fees actually work within the investment industry. It is true that if you invest over a period of time and your overall return is lower by 2%, it costs you tens of thousands or hundreds of thousands of dollars. However, what's not true about it is there's other things to investment return. And if you're going to be doing it yourself to save this 1% fee, mistakes actually cost much more than fees do. So that's the first thing. And just to convince you of what I'm saying, I'm going to give you a little bit of insight in what I do every day. We're going to do a product comparison. So a lot of people will go and say, oh, why don't you just buy an indexed ETF? So I just brought it up. Vanguard, here's your S&P 500 ETF. The key to investing is risk versus reward. More risk, more reward, or more return, right? So the risk of this investment is a 4 out of 5. And when you're comparing investments, you have to compare them apples to apples, meaning the risk has to be the same. The expense ratio, so the fee on this is 0.03%. So you invest $100, they're taking 3 cents. Nothing, right? And this is their returns over that period of time. But I want to highlight specifically the 5-year. Your annualized return is 15.78% over 5 years. Very, very good, right? Market's been doing well in the past 5 years. So simple strategy here, but let's compare it to something that I would use. Fidelity Global Innovators is run by Mark Schmale. Now, let's look at the risk level first. Medium to high, 4 out of 5. So it's apples to apples. And the fee is at 1%, 1.1, right? However, your 5-year return and how they've done, you're averaging 23% net of the fee, right? So would you rather have 15% and pay 0 fee annualized over 5 years, or would you rather have 23% taking the same amount of risk, but you're paying 1% fee, right? It's pretty simple when you look at it like that. And then just to take some shots, I included Wealthsimple's on here, same risk category, 5 years, and they're doing 7%. So if you want to buy that, go right ahead. I included this last minute, but like going back to that, oh, why don't you just buy your ETF and call it a day? Well, which one? You want to buy Canada? You want to buy the States? You want to buy Morgan Stanley's? Do you want to buy commodities? Do you want to buy oil? Do you want to buy gold? Do you want to hedge? Like, it's not that easy, right? It's not that simple. And this is how they're performing over the time. When do you buy them? What do you buy? When do you sell? It's like when people just say that, it kind of rubs me the wrong way because it's much more difficult than it actually seems. So this is my personal opinion, but in terms of where you're going to put your money, this is the hierarchy of investment for me. First things first, you can't start to accumulate wealth if you have bad debt. That would be like credit cards. So like if you're trying to make 10% a year, you're not going to do very well if you're paying 24% a year to your credit card. So get rid of this first. You're going to earn the most return by paying down bad debt. After that, if you run a small business, like I said with the construction example, putting money into your small business is going to earn you more money than it is in a stock market, in a house, and stuff like that. If you don't run a small business, that's okay. I would go to FHSA or TFSA first. Those are your tax efficient accounts. So the way that these work simply, let's just say you put $1,000 in and it earns $500 as a return. You go to take out that $1,500 of net return in there, there's no tax on that. So all of the gains in there are tax-free. If you've maxed those out, like I said, they have contribution limits. So if you've maxed them out, I would go to something called critical illness insurance. I won't go too deeply into it. Miles will speak to it more. But it's a very, very nice product and another little saving vehicle. If you have a critical illness policy, then I would go to those non-tax efficient accounts, depending on your income. Okay, won't go too much into that. And you guys are probably wondering, then I'd say probably once you have enough money stacked up, a house isn't a bad investment either. If you get a house, like I said, you want to protect the assets that you have. You're going to do that through life insurance. And then way at the end is your RSP. And again, like the commercials and the banks push the RSP so heavily, but it's all dependent on your income, right? The main benefit of the RSP is if you put money into it, you're going to get a tax credit. So let's just say you earn $50,000. If you put $1,000 into your RSP, it's now as though you're paying $49,000 of tax. Okay, so for people in low tax brackets, it's not that beneficial because you're going to get taxed on the way out. So let's just say you want to take that $1,000 back out. Well, it adds on to your income. Say again, you're reporting 50, take $1,000 out. Now you're paying $51,000 of tax. So I think this is going to be my most important slide here. I did a lot of research and put it all together. This is the slide that's going to save you lots of money. These are all the programs that are available to a first-time homebuyer in Canada. And so we'll just get right into it. First things first, use your FHSA. The contribution limit is $40K. You can use $8,000 a year. And like I said, you're going to get those tax credits for putting it in. You can also invest over the same period of time. Potential savings, if you use it to its maximum, between $1,500 and $12,000, depending on your tax rate. Next things that I would look at is using the RSP specifically for the home buyers plan. It was getting confusing because I had the RSP at the end, but the RSP has a home buyers plan attached to it. And this was the program that was created before the FHSA. The FHSA just came out in 2023. So this is pretty useless at this point, but if you're in that high income tax bracket, it might make sense. Another great thing that you can look at, save you a couple $1,000. Put 20% down on your home and you'll avoid CMHC, or in other words, mortgage insurance. So mortgage insurance is 1.75 to 4% of your mortgage. So let's just say you have a mortgage of $500K and you avoid that, you're saving between $8,000 and $20,000. Next thing, you're gonna get the home buyer's tax credit. This is something that you file when you buy your home. It's a line on the tax return. I just tell my brother, who's an accountant, to do it, and he does it. Potential savings, well, it's going to save you $1,500. That's the tax credit. And it was designed for these: closing costs, legal costs, inspection, lawyer fees, stuff like that. Which I'll add as a side note, you should probably budget like $5,000 to $10,000 more than you were intending to pay for these things. Last thing that I included on here is a land transfer tax rebate. When you're purchasing your first home in Canada, you have eligibility up to $4,000 of savings, but that likely won't cover all of the land transfer tax. So total potential savings at the end, if you use all of these programs, you're saving between $15,000 and $55,000. So there you go, I've made you money already. We're getting to the end here, so I'll give a quick rundown of the FHSA, this new account, the First Home Savings Account. It's a registered account. Like I said, it's the best account right now to use if you're a first-time home buyer. If you have an income above $20K, putting money in at 0% tax means you get 0% savings. After that, I'd say TFSA Open RSP. And like I said, you get $8,000 of room per year that resets in January. You can carry forward 2 years of room. So at a maximum, you can have $16,000 of contribution room available to you, and a maximum of 40. What's your eligibility requirements for this account? You need to be between 18 and 71 years old, Canadian resident, and a first-time home buyer. And first-time home buyer means you have not owned any house in the last 4 years that you lived in. So if you own rental properties, but you don't live in that house, you're still a first-time home buyer. Main benefits, you're gonna get tax credits for the contributions. That example about putting $1,000 in, $50,000, go down to $49,000 of tax. Get the tax-free growth. So $1,000 in, you earn $500 of return, you get the whole $1,500 on the way out, so long as you're taking it out towards your first home. And then if you don't buy a home and you've used this account, it's going to convert to RSP room. Pretty technical, but we won't get into it. Key points, like I mentioned, if you have a rental property and you don't live in it, you're still technically a first-time home buyer. And you can carry forward 2 years of room. And your qualifying withdrawals are available up to 30 days after you move in to the house. It's not on your closing date. Let's say you buy the house in August, but you move in December. You can take all your money out of your FHSA all the way up to December. And it doesn't matter what you spend the money on. You just need the house to qualify you to get this money tax-free. So that's it in a word form. I'm a numbers guy and I like to look at examples, so I brought the taxes back up. Here's your example of how you're going to save money by contributing to your FHSA. We'll look at this tax bracket specifically. So you're earning some salary between this number and this number, and you're paying, in this bracket specifically, you're paying 29.65% tax. So if you contribute the full $8,000 to your FHSA, you save at 29.65%. So you take 8,000 times 29.65%, and you'll get $2,372 back on your taxes, or you'll reduce your tax bill by that amount of money. So your net money at the end of the year, 8,000 plus 2,000 is 10,372. And what happens if you do that over a 5-year period? That's what it looks like. Your tax credit saving you $11,000 over 5 years, or $12,000 over 5 years. Your net money, $51,860. But what if you were investing that money at the same time? So you took this $40,000, you were investing it, you took these returns and you invested it, and you earned a modest return at around 6.5% a year. Your returns will actually also earn you another $10,000 over that time period. So at the end of the whole term, you've put in 40, your investment's worth almost 62, so you come out almost $22,000 ahead of where you would have been if you just kept it in a checking or a saving account. So that's it for me. Closing remarks. If you want to get started or have more questions, please reach out. There's my number, my email, I'm always available. If you do want to open an account, it's a 20-minute process. We can meet, we get on the phone, we connect financial institutions, and the account's open, and then we're figuring out what the best circumstance is for you. So I'll do a quick question period. If anyone has questions about what's going on with GameStop, I'm happy to talk about it. Or you can watch the movie. There's a movie about it, Dumb Money. It just came out like in October. Pretty good. TFSA is you go to work, you get a paycheck, you have after-tax dollars in your bank account, you contribute them to a TFSA, and that's all the money that you're investing. You're not getting anything back in your taxes. But it should actually be called a tax-free investment account, because if you're not earning return in your TFSA, there's actually no benefit to putting money in there. Because when you put money into your TFSA and it earns return, you get to take all that money out tax-free. Let's just say you were putting it in a non-registered account, you'd be subject to capital gains. So simple example, if you have $1,000 in, you earn $500 of return, and it's in a taxable position, you're paying capital gains on it, that $500 is going to be taxable at your marginal rate. What's your marginal rate? It's at 29.65%. The FHSA has the same tax-free gains, but you also get the tax credits for the contributions. However, if you're in a particular situation and you need the money from your FHSA, not for your home, and you need to take it out, you can. However, it's gonna add to your income the same way that an RSP would. TFSA, when you take money out, doesn't have any effect on your income. Very good. So Michael, I think you're up next. Okay.